making a corporate valuation and a corporate model, which is a course I tried to teach online and I've learned, and this has got some advertising in it. Sorry, I am gonna try to survive without traveling, and in order to do that, I'm gonna make some online classes, but I want to make sure they're not just a video. I'm not just gonna sell you a bunch of videos because I give them for free anyway. I'm going to strictly limit the number of participants. This really sucks, this advertising. I can't do it. I'm not going to have you have a mic that's crossed out. I'm going to make sure, if you can, I'm going to encourage you to email, to use the chats, to use the polls, everything to get information on what you really want to do and how to put priorities on some subjects, not the others. I'm not going to have an 8-hour class again. It's torture. I got to stop the torture. Torture. But watching these videos is torture. And I'm going to make you do some of the screen sharing. I am sorry. I'm going to watch you do it because one of the very big frustrations I have with the online digital classes is if there are more than one person. With one person, everything's perfect because I always have you do the Excel. With anything more than one, I have to do that. That's not going to be used. That advertisement really kind of sucks, doesn't it? Now, now let's go to the next section. So I went through some of the valuation theory, and then I went through this key thing. Oh, good, I have a suggested. And then I went through uh, the getting the historic data into the model. And now I want to start modeling, and we're going to use a switch. You know, I really should have put, that's the wrong kind. I shouldn't make a, the valuation model. Okay, now the very first thing I would do once we have the history, I'm going to use this historic switch. I cannot believe people don't use it. For me, now that as soon as I started using it, it became such an obvious thing to do. We'll do this for the other. And what we can do with this timeline and with this historic switch is uh, uh, we can put alternative timelines. In other words, if you want to make a quarterly forecast or have quarterly history and an annual forecast or whatever you want to do, you can be very, very flexible. That's what somebody asked me in this one attempt I made in the class. And then we're going to use just a switch, 1 = 1 is true, and multiply in a parentheses like this, you know, okay. I'm going to do it like this as well. So I could put like this and just multiply it by 1 and not bother with an if statement. Okay, to find 1 or 0, which is the same as true and false. Okay, and we'll have to use a generic macro and all this. So I started out with the dates. Now, I'm going to kind of go backward here because I think the first thing to really talk about is getting an assessment of what kind of returns have these companies made, how can you make the valuation, and what can we get kind of from history. And now we've got 3 examples. One is Macy's that I said we'll use. The main one is Amazon. Now, Amazon has made a lot of capital investment. If you look around, they have warehouses, they have trucks, they have probably some inventory, God knows how much. They also have some research and development, which you don't really call invested capital sometimes. So there's some issues with that. And the question is, what kind of return on invested capital can they earn in the future? Now, we should also talk about return on equity versus return on invested capital. When I was much younger, I used to always be completely obsessed with return on equity because I used to testify about WACC and stuff for utility companies, and everything was about return on equity, return on invested capital, you can argue, is better than a return on equity because it's not distorted by leverage. And here we'll use the Apple example. I want to know how much Apple is making by selling its iPhones for a high price, selling its other stuff, getting you addicted to their phones. I want to know their core damn business. And I don't, they're what we said in the last video, if anybody watched it, we saw how Apple, the financial position of Apple changed so dramatically when the cash changed. And that's going to affect the return on equity, but it should not affect the return on invested capital. Now, the other thing we did in the last video, we saw that Mercedes-Benz, Daimler, whatever it was, the forecast had the return on equity going up and the return on invested capital going up. And then you got to ask, what are they doing? Why can they do this when they haven't done this before? You can also, if you really want to compute return on invested capital, you can do it on a division basis. This really comes from, I almost should put another thing here. I'm making too many slides, but this comes from Modigliani and from Modigliani and Miller. And I'm bragging, one time in one tiny little meeting, I met them. And they didn't. I don't care if you say their model is disproved, and I argue against it all the time anyway. But the fundamental idea is to separate out the operations from all the other stuff. Okay, and we really are trying to figure out how well what the company is actually doing and make our valuation dependent on that rather than gimmicks, little optimal capital structures and all that. Okay, now we're going to go through, and the first thing I'm going to do is make a little ROIC calculation. Let's do that for Amazon and Apple. Okay, for Amazon, it'll really be pretty easy. Now, this is another thing I'm trying to do with. I closed the model. Now, notice when I made this Amazon, I did not do any coloring because one of the things I want to do is I'm not selling generic macro sensors for free, but I want you to use it and to make suggestions on what to do. Now, what we really want to do, and hopefully I'm going to practice this again, I want to be able to explain ideas as I go through some of these models. Now, what we have to do is go through and identify the real assets that are involved in actually Amazon. This is Amazon making money. Now it needs inventories to run its business. It doesn't really need the cash. I'm going to assume that's excess cash. Okay, right. You could have some minimum cash and you could waste a whole lot of time. And then accounts receivable, that's part of running the business. Deferred taxes, we have no idea. Luckily, they don't have this. Deferred taxes get very complicated because some of the deferred taxes could be related to these fair valuation of derivatives and what have you. Now, since we've got all these identified, we don't have to put anything in this category. Plant they need. Goodwill was from buying companies associated with the business. Operating assets, we don't know what this is, but I'm going to assume it's related to running the business. And I'm going to assume, well, this was to make the balance sheet balance. I had a little problem. I don't know. Forgot why. Whatever. I'm going to put that in. No, nothing here. And then we go to the liabilities. Now, accounts payable, but that's a deduction. That's like, you've got to be so careful when you really think about that. Somebody's investing in your business, these suppliers. They could demand payment up front and then they would get a lower price, but that would affect the EBITDA. you know, or the employees, if you paid them faster, maybe they take a lower salary. You can go on and on about this stuff, but it's easy to say that that's related to running the business. Debt, on the other hand, that's a financial asset. So is this, so is this. I think preferred stock's already in equity, so we have this. And that's the first thing I do. Well, maybe not exactly the first, but we go through the assets. This happened to be a really easy one because other ones get really complicated, and we'll get a little more complicated after that. And then you just kind of go through and you use the sum product, then you press F4, and then you better have exactly the same number of values here. And that gives you the invested capital, a negative one. Now, oops, I have which, I'm not so afraid of these things anymore. We could do the same thing, some product, because, what happens is we don't have any research and development. We don't know what's a real investment. Some of the marketing might be really an investment. You don't get paid immediately for the marketing. Some of the business strategies really might be more like a capex. But look what it did. It gave me the same number. I could even take this difference. And, somewhere I'll talk about fast modeling standards, which is nice to talk about, which nobody ever does. But if I sum this and then put an equal 0, it says it's true. So I put a little test here. All right, we've got the invested capital. Now I'm going to look at computing the return on invested capital. The first thing you do is you go up to the income statement and get the operating income. And then you go up to the income statement and get the tax rate, pre-taxes, and then you compute the net operating profit after tax, which is EBIT times 1 minus the tax rate. And we have no idea what to do here. Somebody might give you a rule, but that would be silly. Or we could, make some kind of thing and see what happens if we change this. And then now, oh God, I should do that maybe. I'll put the bounds. Let's put if it's between 30% and 15%, then we take that. So, whoops, 15%. And see, this is the kind of stuff I shouldn't do. And if you ask a question, I'll do it. And then you can say, well, that's the tax rate, but it's going to be the maximum of this tax rate or the this one. So we'll never have a negative number. And then we can put a minimum around that whole thing and take the minimum of that one or this number. And I hope I made a crime by not pressing the F4 function. Shift Control R. I'm not going to go. I've been blabbering on way too long about my generic macros, but that's the Shift Control R, and some other people have the same thing. Makes me a little sad. I don't think they stole it from me at all. Then you can take, now when you have got to understand a tiny little bit of accounting. Net operating profit is from January 1st to December 31st of their fiscal year. They ended February or something, whatever. It's a year, it's for the whole year. The balance sheet, that invested capital that we computed up here, which came from way up where we did it, that invested capital is just the end of the year. So what we really should do is take the average of the beginning and ending balance every time. This depends on how sophisticated the class are. These kind of things I could go through really quickly. Now I have a negative number here, so we get kind of a wacko negative number. And the fact that I didn't mess up that minimum and maximum is kind of cool. So I'm going to do the same kind of thing here. And for a graph, we'll just kind of get rid of these really small numbers. So we'll make the minimum minus 10% and the maximum maybe 50% or maybe 100% even. So we get rid of kind of these two things. So again, you put Minimum, I'll do it with the minimum of this or this. Okay, so that's still that, but then we'll do the maximum of this one or the smaller number. Okay, not something I generally recommend. And then you can go up here and insert a little spark line. Where's a spark line? This one. Perhaps we'll do this one. And there's a little other stuff I do, but okay. That's stupid. Where did we get the really big one? Then 100%. Maybe I'll put for now 30% so we can kind of see what's the trend. They've had some really low invested capital years, and I don't know if I like this stuff anymore or not because you can't really see it. The question is, this is really what's happening. If back when our friends did that other valuation from Tufts, they said, oh man, some of these invested capitals were nothing. And let's put 3,000 minus 1,000, so they said, they've had some negative earnings years and then they had a positive one and a negative one. What's going on? Okay, and then I do the same thing with equity capital. We just go to that one, and that maybe it's a better indication or not. I'd look at both of them in a way. Equity capital is clear. The good news about return on equity is that it's not as distorted. There's not as much judgment. Let me show you something else. Okay, I said we'll look a little bit at Macy's as well. And that their return on invested capital was higher than Amazon. Now, this is where it gets a little bit tricky because I'm going to put this in a new spreadsheet, and I haven't done this for a while. We copy it, and you use my little tool, which maybe you have a zillion other ones. I have this friend who seems to buy every little gimmick there is and pay all this stuff, and a lot of it probably works a lot better than my stuff. And then you can get it here. But this is, look at what they did. Add back losses on gains, add back settlements, add back rental expense, adjusted EBITDA excluding benefit plan income, net lease and expense. And then they must start with the assets, and they add back capital leases. And then the final thing they do, let's put 0.01 and copy that. Yes, and then they come up with the return on invested capital. Okay, it illustrates the big idea is it illustrates how absurdly complicated you can get on this, and what does it end up meaning. And there is a point to this, because now let's look at Apple. Maybe I'm going to save this because I'm stupid. In the last one we read, we got the balance sheet of Apple way back since who knows when. I need to put a couple of things here. Okay, and what happened with Apple, again, I'm going to do the same sort of thing now. That there are two, for me, there are two big issues with Apple. One is the on their profit and loss statement, they have a whole lot of net income, okay? Good. And they have other income. If you look at their research and development, though, they're spending 16 billion here on research and development. That's relative to 98 billion, so it's not that big compared to their gross margin, but compared to their operating income, it's still not that big, I guess. But if you look at their whole balance sheet, well, it's a lot more than 16 million. And what is kind of the big items on the balance sheet? This other assets that we have no idea what it really is. If we would capitalize certainly if we would capitalize that research and development and increase the income, take it out of the income, and then we'd have to figure out how to amortize it and everything else, we'd get a really much clearer picture of what's going on. And return on equity does not solve that by any means. Return on invested capital forces you to go through that. And if a company has a big write-off, the return on equity is all distorted. So these people at McKinsey and all this claim this return on invested capital is this fantastic thing to look at, but it's kind of tricky. So let's just look at apples for a minute. So our cash, we'll put that as a -1 and a -1. I think I'm going to do it both ways. So this is our financing, and then we'll do our direct method. And this, if people have kind of questions, I want to digress a little bit. I'm going to call this one. I'm going to call all these related to the assets. This big one is -1. This one is 1. This one is 1. They had some goodwill that now they seem to plop that into other assets there, other non-current assets. I'm going to pretend that's 1. Acquired intangibles net, and then they had these big assets that suddenly appear. No, that's totally non-current asset. Excuse me. Oh God. And then accounts payable. Well, that's related to the business, accrued expenses, and all this. And then we get commercial paper, some current portion, other non-current, other that, and don't include the totals. I was just about to do that. And the total long-term debt, I kind of didn't classify very well. And then we have the total equity. Okay, and then we can put these. That's how fast you can do it. And then we put invested capital, invested. Now, nobody told me about this stuff ever, and I don't know, maybe it's standard kind of ways to do things, but we can take all of this stuff, and then we put a comma, and then we look at that, and we press the F4 key, and you had almost no invested capital. And that invested capital, if you compare that to the balance sheet, I guess the balance sheet kept going up. I was expecting it to go down because of, like I told you, our total cash and investments. This thing, and I did this in our last video, and alternate F1. This thing, we don't want to distort all of our analysis by this strategy of they did this for tax reasons, of course. They kept all their cash at some offshore accounts, whatever offshore is, and all that stuff. And we can put the invested capital with the financing. So I'm just doing this because, frankly, I'm curious about it too. And then I'm practicing some product, okay, and oh God, all right, and we'll take all of this stuff and then multiply it. I think perhaps you could have just used a comma, probably, and we get the same answer all the time. My God, this used to take me forever. And then we go to our income statement, and the first thing we get is let's get their tax rate. Let's just see how much tax they avoided. Okay, and the tax rate is their provision for income taxes divided by that. You could get the actual taxes they paid from the cash flow statement. Right at the very bottom, they have the cash paid for taxes. Let's compare that. Cash paid for taxes. Shift Control D. Oh, I can't do the Shift Control D. Oh, sorry. Shift Control R. Maybe not that different. Lower, lower, lower. It's always lower. A lot lower. This is the cash taxes. And then we don't have the real cash pre-tax income, but let's use our income before taxes divided by those taxes. Whoops. The taxes, excuse me, divided by those income before taxes. I'm not listening to Napoleon. And then we had 14.7, 14.3, 17, 18. This is probably a more realistic kind of a tax rate. So the first question we have about the net operating profit after tax is which one to use. I'll use the higher one. I'll be conservative, and then we can put our EBIT, which is just we don't have to make any adjustments for depreciation or anything, and then we can get that, and then we can put after tax. Okay, and we take this one and multiply it by 1 minus the tax rate. So when when I teach my classes in person, I'm not allowed to do corporate finance anymore, kind of. I have to do all this project finance, which I kind of like better anyway. But, and then let's put the invested capital. Okay, and take the average we'll go to the balance sheet and take the average of this one and the last one, and don't worry about the first year. So they had almost nothing, and then we get the ROIC. And the idea here is this ROIC is supposed to be the amount they're making, which is way over 100%, 900%. It's supposed to be and then it's going down because the invested capital is going up. But I don't know, it's so ridiculously high, it's almost not worth looking at. And that's because I think they outsource a lot of their plants and their CapEx. If we looked at the balance sheet, their CapEx would be really low. But if we looked at their ROE, which let's just use the return on the ending equity and not bother with the average, which we should be doing, and looking at the shareholders' equity, that's only 16%. And let me do that again. The net income in 2008 divided by the balance sheet equity capital in 2008. Okay, there we go. And their return on equity, when they did this getting this cash back, their return on equity went way up. Sheet here, and do our alternate F1 and show you what's going on. This is what I started with. Now the return on equity is going up, but the return on invested capital, I almost don't want to show these. Let's take these ones out. This return on invested capital, which is really the money they're making when they sell you the iPhone and all that, that's coming down. Okay, I'm not really worried about that if I'm still an enormous number. And then we could even, on this invested capital, we could say, let's accumulate and you'd really have to do this R&D. And, I don't have any special insight onto what to do because it's an extremely difficult thing to do. But by the time we've accumulated it, we get to 30 billion, which is where's our invested capital, which is a big percentage of the invested capital. So let's make an adjusted one where we take this one plus some R&D. Now we would have had to go back further, of course, and then we can have an adjusted no plat here, and we better, if we're really simple, all we'll do is take our operating income and add back the research and development. Okay, and maybe I'll yeah, and maybe I'll just then multiply this by 1 minus the tax rate. I hope that's what I did before. I hope I did it by 1 minus the tax rate. These cash taxes. Okay. Yes. Okay. And then, so now this is our adjusted invested capital. And then we can have an adjusted ROS. see. Okay, and then we'll just take this divided by this one. Okay, and we get this really high number, and then it comes down a lot more. We got it's kind of a really different picture, and the trends are even more different. Okay, and I don't know what the right answer. I do know that that's more than the cost of capital, and you definitely want to grow. And then the problem with Apple, but that's an interesting subject for Amazon too, is people thought it could never stop growing maybe, and then it's not been growing all that fast. All right, or kind of gone down in a couple of years. And now what happens with all the arguments between the U.S. and China? Go, who cares? Who, whatever. All right, enough of that. Now, so that's our return on invested capital, and for me, that's really where to start. And then we take it and we make some assumptions. Now, I've been struggling forever on really trying to think through assumptions rather than have some stupid little rules and all this, or take and make some automated, take the history, make a regression analysis. Come on. If you have demand growth that's volatile, here's what we do know. If you have demand that goes way down and you have a gigantic capital investment, like Marriott maybe, that really hurts. If you have demand that goes down and all you have is a tiny little street thing, where I used to go to Thailand a couple of times and you could buy the street food. Well, okay, the demand went down, but we don't have all that capital stuck in our business, so we can just move it. Okay, that's there's more volatility really in income for a capital investment invested business with a whole bunch of capital than without. And then we have to understand, well, how volatile can prices really be? And this depends on the cost structure and the marginal cost. In the oil business, right now, the oil went down to negative numbers, because of the storage business. But in the oil business, you have kind of a floor, which is the variable cost of getting the oil out of the ground for some places. It can be all volatile, but it can go up and down. Other things might be all capital. All right, we understand. For me, almost nothing scares you worse other than the shocks in demand, the surplus capacity. How all other things are like going out of style, like Amazon taking over Macy's and all that kind of stuff. And international competition. If you think you've got a good thing and then they come in and build it much cheaper, you're done. It's a finished price speculation. I can't go through these. I have to come up with a really better way to do this, but now I'm going to go through and put some different growth rates for Amazon, because when we do this, for me, the scary thing is to just assume constant growth rates. So what I did in our Amazon model, and now I want to give you something practical. After we kind of work through the returns, and there is no rule here. I'm liking the quote that my friend in the 1980s gave me. He died of another virus. He was a good guy, and I don't think I'm whatever. He said, foolish consistency is the hobgoblin of a petty mind. And when you say, oh, there's a rule for how you have to make your revenues and OPEX and all that, here is the real key for me, is to just make some sections and then just start doing it, but make them nice, kind of good sections at least. And I don't have here. We're going to then compute some free cash flow, I guess. Most of this is going to be finished. I was going to have to do a generic macros colorization. So let's do it like this. Now the first thing, I really should have done this earlier. Okay, for Amazon, the very first thing is to put some. I might want a little. This is not finished, of course. Excuse me. I think we might want to put some the last historic here. Now, I used to be terrified, and the last year is and what we want to do, not 2019, and what we want to do is when we get a new financial statement, this was all this business before, we want to be able to just add this new financial statement here and have everything work smoothly without redoing the model. Now, I would always probably redo the model because this really doesn't take all that long. So I'm going to take this and then I'm going to use something for project finance, and I'm going to say, well, how many periods per year do we want? Let's put periods uh, uh, periods per year history. Now that's for now. That's in I'm going to put months per period, and I'm excusing it, and let's put that in months, and let's do that for the historic period. And this is a lot of times, you know, you can borrow concepts in all sorts of things from one area and try them in another. This is really, for me, a fundamental project finance concept. And let's put 12 periods per year. That means we have monthly, and then we'll put periods per year for the forecast, months in periods, rather, forecast. And then we'll do that again here. And then let's just make that quarterly. We're going to make a quarterly forecast. And then we'll have total, and then let's put a first historic year. Okay. And then we a year. Okay, not this is year two. And our first historic year was uh, I'm going to use the 2008. I should have, because that's in our timeline. And then we have historic periods, and that's just the difference between it's 2019 minus 2008. Okay, we have and this is periods. And then when you do your time series, now, of course, I didn't, excuse me, in my little exercise, I didn't have this. And this is exactly the kind of stuff I would do. I'm talking to myself, period counter. And for me, I've just done so much of this crap. And I put it in the wrong sheet, of course. Uh, uh, and that almost should be the very first thing we do. Uh, uh, so I'm gonna move the year down here and really borrow some of it. Now the first thing I'm gonna do is just start here because that's one, and then Alt-EIS tab, and let's do 40 periods. Okay, probably way too much. Uh, I'm gonna delete this graph for now. Not that much too much. Okay. That's what you'd really start with, long enough. And then let's put this as a historic, let's put the uh, historic period. And I'm going to do that a little bit differently. Okay, and then I'm going to take what's over in the left, and I'm going to take 11 periods. And I've never done anything like this before. But just if you use some of these ideas, so we have a little true and false, and I should have put a +1 here. Okay, oops, not +2. Okay, come on. Okay, and this video might be very long, and I'm gonna just go ahead and leave it long. So there's our last historic period, and then I'm gonna put months in period. Now this is what transparency really means to me. Transparency means you put stuff in the left column. It's as simple as that. And we're going to make it I'm going to make two drivers up here. I should have put this one up here. And no matter what, I think that's what this flexible, accurate, transparent, structured, whatever means. And of course, my classes aren't very structured, are they? I don't use these principles in my life enough. And then I'm going to just put, if it's the historic period, we have 12 periods per year. Otherwise, we have three. And of course, I did it wrong, and everybody else, if we just go up one, that's what transparent thing means to me as well, is that you always go up and look for something just above. So we have 12 periods per year, and then we switch to 3 periods per year. And let's make this one, and let's make the start date. Let's put a little start uh, date, which kind of, I'm going to put a date, old-fashioned date thing, a year, 12/31, no, 1, comma 1, minus 1, okay? Shift Control 3, and then we'll take that date up here, and that's our starting point. Obviously, I haven't done this before. I'm repeating myself. And then we'll use a edate function, and let's take this one, and we'll always kind of go to the end of the year, and then we'll go up and take it 12 months from then, and Shift Control F3, and then we have this. And what happens is it goes month by month by month for the end of the year, and then it goes to the end of the quarter. Actually, this would have worked better with EO month. Excuse me for that. Okay. But I hope that, and I'm making some mistakes. I'm not embarrassed that much to make mistakes because it comes so natural to me now. And maybe that's a little prettier to do the end of the quarter exactly like this in case I missed a day. Okay, and so that's how we could make our timeline very flexible. Now, when we make our timeline really flexible, you'll use this months in the period all the time, because if you're having an operating expense historically, you'll want to divide this by 12 and multiply this by 3 over and over and over again. And the growth rate, you'll have to do a little bit fancier, maybe put it in a monthly growth rate, raise that to the 12th power, raise this one to the 3rd power. There's all sorts of things you can do just by having that little timeline here. But now I'm going to put it back to 12, and now we've just made our model all annual. So please don't be afraid of this. Now, another thing I did, which I can never quite remember how to do, I put in my website here, oops, in my website, I hope it comes up, I hope it's there. I put a thing, and now I gotta find this, tabulating monthly sums. And what I would do in a class, this is one of these things where you want to get it, in this case it looks like I have, oh no, I have 12 periods, and then you want to put a little sum thing at the end, and you want to do that all automatically. In this case, I have quarterly, and I go through step by step how to do that. Oh, I hate doing that so much. I haven't done that for a while. You have to use a little bit of a match and a sum if to do that, but don't do it by hand. Oh my God, don't do it by hand. So that's a little forecasting. Now, the question is what to do once you have this uh, 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 here in this shift. How about we'll put Shift Control 3 again to put our dates here. And then we can put our historic revenue growth, and we'll use this historic switch so much it's kind of ridiculous. If it's the historic switch, well, let's just go up and go to the income statement, and I don't have any special rules here. Again, I'm repeating myself, and get the growth rates. So these are the historic growth rates of the company. And the question is, can you really assume that they're going to last that long? Now, I said, no, I always struggle. Where should we put the assumptions? I don't want to put a whole gigantic set of assumptions here. These days, because I've seen it's like a cancer when you start putting too much assumptions and messing up your models with that. So I said, okay, let's put some different revenue growth scenarios down here. And I said, this is the key thing is just to discuss this, and here they are. Okay, of course, I say of course, but if you've ever watched the video, I use the index function all the time, and I have this really neat little model that illustrates it, or you can use sometimes the choose function. Okay, and then you go here, and I have you do a little bit of this, and then we can have a base. So our base case, I have the growth rate going down. Who knows when it'll go down? Maybe you want to make these flexible and just make them go every 5 years, every year. Who knows? But if we put the high case, let me show you something else. Let's say that we get 30% and it only goes down to 15%. That does not seem like an unreasonable forecast to me. Now, when you put that in, let's just do a little bit of an implement. You could just use the lookup function, okay? Please never use VLOOKUP, never use match and index when you have a thing. And I guess I have to put equal year here, okay? And when you use the lookup function, my suggestion is, of course, always to use the entire row. And then my suggestion is to put in a variable at the beginning so you don't get these NAs at the beginning. That's just a stupid little trick, isn't it? Not fancy. And then you put in the one from here, and you get nothing in the historic period, and then it starts to go after that. And of course, I didn't continue this. And then we get our growth rates, but our growth rates suddenly go down. And then I've been moaning about this forever. I saw somebody else actually try to charge you for this interpolate. I don't know why people don't like this interpolate lookup thing very much. Hetty does, and that's nice. And that works just like the lookup. Okay, and if you want to see this, and now what I did is, of course, I put it in the file, so I'm not showing it. And then the growth rate gradually goes down instead of suddenly goes down. And then it just kind of stops because you're at the end. All right, and then you know what I did? I put how much the US GDP was. And I know Amazon sells in anything else. Now, you could really combine it, but I'm going to say if it's true, then let's take the history. Otherwise, let's do this interpolation. And then when we go, we put our forecast in. I'll use the historic flag again. I'll say if it's true, then we'll take the actual revenue, which would have been nice that I put the actual revenue up here, but I didn't. So that's very bad. Otherwise, we'll take the prior year revenues multiplied by 1 plus the growth rate. You can see that, the historic we didn't really need in this case. And then we get our projection. Now, if you use the high case, if I use the high case, the US GDP is this. And if I go out to 2040 and take that divided by the US GDP, I get 69% of the GDP. That shows you how dangerous the high growth is. There's one thing that can't happen, and we kind of showed it in the Apple case. You can't just grow and grow and grow forever because you get really fat and you start exploding. China can't grow forever. All of this stuff, okay? And then now when I do cost of goods sold, I think you should take out the depreciation and then compute the margin. And I'm kind of curious on this one to go over to our Apple case. I did the gross margin here as just the gross margin, I'll call that percent. Now I'll take COGS minus depreciation. Now I'm assuming all depreciation is in cost of goods sold. I know I can't do that and all that. Okay, but we have to go to the cash flow statement to get our depreciation. Okay. And I can't do this one. And now I can put my adjusted, oops, uh, margin. Okay, and that is my my adjusted cost of goods sold, and that's just going to be these cost of goods sold minus this one. Oops. No, I already done. I'm sorry. Sorry, adjusted margin. Excuse me. That's just the sales minus our adjusted cost of goods sold, and then let's see how much of a difference that makes. Maybe it made nothing. 36% versus okay. Did I do something wrong here? And where's my gross margin was 62, it's 42, but it's really kind of holding much flatter. Look how flat it is. And for me, that's a big deal. And that brings us to the kind of next thing in forecasting. Now, I've gone through these things over and over again that you need to understand what a fixed and variable cost is. And I think then you go through now Amazon, this is kind of why I got all this history. They had their operating expenses for fulfillment. I don't think that means that you're some psychological term. I need to do another thing about my psychological problems. And then we have marketing. And I wondered if the G&A, I wondered if the story behind Amazon was really that this company has this operating leverage, meaning that it's getting so big, their cost structure is coming down. And you see that interestingly with cost of sales. Perhaps they used to, the cost of sales now includes their own trucks, and it didn't before. Their cost of goods sold margin has come in, but all these other things have just stayed the same. And my suggestion here, when you make this model, is not to follow any stupid rules, just to go out and see if you can get anything. But when they were growing, these costs went up, and I tried to make my little graphs over there. These went up. The only thing that came down dramatically was the cost of goods sold percent. And the question really is, how much can that come down forever? Can it keep coming down forever or not? That's a big deal. I think eventually they can't really charge whatever they want. They're compete with, if they started charging really high prices when somebody else can sell something online, they're going to have a problem. I mean, their returns can go up, but not infinite. Enough of that. And then here's the big deal for me, and I think this is going to be the last subject here. Now, if we change the growth rate, don't you think we have to change the capex to support that growth rate? That, for me, is just about the trickiest problem and the hardest problem. So when we go through our capex, let's just do some capex analysis. One way to do the capex would be to go to the cash flow statement and just take the historic capex and do something like their historic capex as a percent of sales. Maybe that wouldn't be all that bad. They have acquisitions, have property, and they have acquisitions of companies and all that. The other thing you can do, and I tried to even put it right here in this thing, just to remember, it's not that hard. I don't know why I didn't do this forever, kind of. I put this one here, and oops, and I just said, look, instead of this, why don't you just make a little formula? Why don't you understand that net plant plus the capex minus the depreciation, net plant is last year plus this plus capex minus depreciation. Why don't you just take the implied capex from the balance sheet and do that with other assets? That's an easier way to get some of this cash flow. Maybe you can argue with me one method, and I'm not emotional about that one, that's for sure. So one way to get the capex is to directly go to the uh, uh, cash flow statement. The other one is to go to this net plant and get the capex like this, get the implied capex. And that's what I did. Okay? Maybe that's so cool, interesting. And they spent a lot. 28 billion, that's a lot. I should have perhaps done this, with our flag. Okay? And that's all you have to do, by the way, because then it'll stick a false in at the end. All right, and false is just fine there, I think. And then you can say, well, should we compute our capex as a percent of sales? And then who knows? Here, this capex was going up as a percent of sales, kind of like some of the others. We could use that perhaps, but I said the other way to do it is maybe use the capex as a percentage of depreciation. Now, when you change the sales, and again, on this one I put if this should have just been what happened here? This should have just been this true false, I think. Okay. I hope that then this kind of went up. Now, if you're growing fast, you're going to have a different capex to depreciation. And what I suggested doing here is as we change the growth rate in our sales, let's put different capex to support that growth rate. I suppose you could have done it, and please, you could have done this as capex to sales. Maybe that would have done the same sort of thing. Okay. All right. But I did a little more explicitly. And then once we have the capex to sales, and here's how I did it. Okay. I go through this thing, and I'm going to go through it again. Okay. And what this does is it says if we have a different level of sales growth, we get a different ratio of capex to depreciation. So when you change the sales growth, you can make your model automatically kind of be a little more theoretical. And the way I do this is I just say, okay, let's just put a starting capex in here, okay? And I don't know why I did this. And then let's put the closing balance as the opening balance plus the capex minus the depreciation. I've done this so many times. And then I you know what I'm going to do is move this here and then put a equal sign and take this times 1 plus the growth rate. And now we have 25% growth rate, okay? And that's our plant balance. And then if, oops, oh, I gotta do this. And I go 100 years or something crazy. And then I say this, we've only got a 5-year life, so our depreciation rate is 20. I'm going to use the opening balance. I struggle with whether it's really the opening balance is better. But then this is gross. So what I have to do is I have to say if it's capex to depreciation stabilizes, and if I put a 10% growth rate here, the ratio of capex to depreciation completely changes. Now, this is not exactly a right thing to do because this ratio of capex to depreciation depends on the historic year, and you can get all much fancier. But you can say, okay, if I am changing the growth rates, if I'm doing a case that's not that ridiculous high case, and if I'm doing a base case on the growth rates, then then perhaps what I can do is change in my assumptions for the capex, change the ratio of capex to depreciation. And if you have a longer book life, if you have longer assets, you get a different kind of ratio that changes. And once you do this, I made a little data table that says, okay, let's change put different growth rates up here. This is just a little one-way data table. And let's get for different growth rates what the difference ratio of capex to depreciation is. And then all I do is finally, now I'm not suggesting that you do this necessarily, but I'm suggesting you understand these kind of relationships that will come into play later. You can do that with net plant depreciation rates that change. The net plant depreciation rate changes as the growth rate changes, as does the capex to depreciation. And then once you do this, so if we have a base case and our growth rate's changing, of course I know that I should account for the historic changes too, but we can kind of be a little more reasonable about how we change the capex to depreciation. So this illustrates, and I'm going to stop here because this video is taken a little bit long. I'm not that sad about it, actually. I'm going to maybe do one other thing. I'll press Shift Control, Control Alt C, and put my thing up to be 7. And let's run the stupid thing. Okay, I have mark links to other sheets here. This is mark links from other sheets here. And then it goes around, and hopefully it'll work. And I can keep having to debug this a little bit, and we look at all our kind of categories, and we just work through assumption by assumption. That's our inputs, and blah blah blah. And now we'll get into the valuation issues. And this was just supposed to give a guide. Now, what I would really do is each one of these videos would be a separate session. I've lasted an hour, which is a long time for a video. I'm very tired. I'm getting sick of this completely. But if my online classes would be about 3 hours, and I think 2.5 hours, something like that. And you'd get a break to go to to whatever in the middle, and there'd be as much question and answers as we have, and we go around. And if I'm a little late, I'll make a video to follow it up, and that's the way I want it. I want to see if I can really do these kind of things in a much more interactive way. That I can press, the Control Alt C to table of contents and all that stuff too. So that's the modeling part. Okay, a little bit of discussion on the modeling part, and I am going to stop this video, and we're getting past it because now I'm going to go into the valuation part.
Mr. Martin, who are the most important people in this situation for you and for the family? You know your family best.
Mm-hmm.
You mentioned your siblings, their wives, and your father. I'm just wanting to know from you who are those people that are most important.
Well, the most, I think, supportive has been my wife.